So what is depreciation? It can be a little bit confusing, but it is a concept that exists in the accounting and tax world. And the concept is this: assets that are put into use for business purposes or for income purposes are given a useful life. And the IRS has determined that a rental house has a useful life of 27 and a half years. So let's give an example. Say we bought a house for $300,000 and we said the land was worth $25,000 and the building was worth $275,000. That would mean that over the 27 and a half years, at least from an IRS point of view, the house would be worth zero. Now we all know that's not true, that houses last a lot longer, so we can use these rules to our advantage. What that means is every year we get a $10,000 deduction. It's like $10,000 of value of the house at least disappeared from an accounting point of view, and we get a tax deduction for that. So let's say we had $10,000 in net income for the year. Now we have this $10,000 depreciation expense, which didn't actually cost us any cash. We would end up having a taxable income of zero, which means that we wouldn't owe any income tax on the investment for that year. Now let's take that same example. Say we made $15,000 for the year and we had depreciation of 10. What would happen is we would pay tax on 5,000. Now, but we actually generated $15,000 of cash, and we're going to distribute that to our investors. So what does that mean on the 1099? On your 1099, you're going to get $5,000 in ordinary dividends, because that's the amount of taxable income we have. But we're also going to note that you have $10,000, and it's called a non-dividend distribution. And we're just noting that we gave you some of the money back from the investment, but there was absolutely no tax impact. It does not have to be reported on your tax return, doesn't result in any additional tax being paid.